And welcome back to Yahoo Finance Live. We've got about 90 seconds to the closing bell. So let's bring into the stream Jim Bianco, Research President, as well as Michelle Connell, CFA and owner of Portia Capital Management. Good to have you both here. And I want to start off real quick with Michelle, and we can continue this. But you seem to think that the market is telling us that things have stalled out. Why?
I think it's a combination of factors. It's the fact that we're looking at potentially higher inflation, and the Fed is starting to signal to us that they're going to take their foot off the accelerator yesterday by announcing the fact that they're going to start selling corporate bond securities back into the market. I think the market is concerned that things are heating up a little bit quicker than we anticipated, and therefore interest rates are going to go higher.
All right, so we're going to pick that up on the other side of all of this, because we also heard from John Williams. Brian Chung here at Yahoo Finance interviewed the New York Federal Reserve Bank president, who in regards to the potential tapering said that, quote, right now we are not near the substantial progress marker. But as we head towards the closing bell, let's see how the markets are reacting. And you can see that at this moment, the Dow is off about 13 points. S&P 500 is off about 14 points. NASDAQ is off about 138 points. Sector action today, we still see consumer staples in positive territory, up about 0.5%. Healthcare is also up about 0.5%, and utilities up almost 0.75%. But energy is positive. Energy's been the leader this week. Energy sector still also higher. Let's go to the closing bell and see how we settle this Thursday.
And that closes out today's trading day. Again, taking a look at where things stand. The Dow closing off 23 points, S&P off just around 0.3%, the NASDAQ down 1%. Not a heck of a lot of movement here in the final couple minutes of trading. In terms of what is leading the way lower inside the Dow, Intel and Boeing, those two stocks off more than 2%. Salesforce is also an underperformer today. Sector-wise, we're seeing the declines led by consumer discretionary, communication services, and technology. On the flip side, utilities outperforming today, as well as healthcare and consumer staples. We want to bring back in our panel. We have Jim Bianco and Michelle Connell here joining us. Jim, let me toss it to you, because outside of some of the action, when you take a look at the broader major averages, it doesn't look like a heck of a lot was going on outside some of the pressure that we saw in those big tech names. But what about the meme stocks, the AMCs, the BlackBerries that have been getting so much attention here over the last couple of trading days? What's your take on that and any risk that it potentially poses to the broader market?
Yeah, well, Reddit is not dead, and the meme stock theme is not dead. There is a big, powerful audience out there that can still push those stocks around quite a bit. It seems like we're starting to get to the point now where the broader market is starting to notice it again, like it did in late January. And should we continue to see the meme stocks continue to go, maybe a broader systemic problem will become a worry, not a problem, but become a worry like it was in January as well, too. So the meme stock thing is not over with. Reddit is not over with. I think we're going to have to settle in and realize that this is just part of the investing environment we now have in 2021.
Michelle, when we look at the meme stocks and their impact of retail investors on the market in general, I mean, John Williams doesn't seem to be worried about what we're witnessing, whether it's AMC or GameStop. Should we?
I think Jim makes a valid point. I think we're going to have this as a continuation within the markets, where you're going to have the institutional investors, but the individual investors, the small guy is going to be more of a factor. In the past few weeks, you've seen more of that individual investor that was in mutual funds. They're starting to get out of those mutual funds and get back into individual meme names.
Jim, when Brian was speaking with New York Fed President Williams earlier today, John Williams earlier this afternoon, they talked about inflation and whether or not what he's seeing is transitory. And he basically pointed to the fact that some of the increases that we're seeing right now, they're simply reversals of the price declines that took hold in the midst of the pandemic. What's your view just on inflation? Is that something that you view as here to stay, or will it likely be transitory and the Fed's right?
No, I don't think inflation's transitory at all. I think that it's real, and the Fed is at very great risk of having it being used, their terms, unanchored. I think that they've probably gone too far And when I say they, I also include the federal government with too much fiscal stimulus. And my worry is that inflation will become a problem. I know Michelle said this, but my worry is it's going to be even faster than we think, that interest rates are going to go up a lot faster and a lot harder than people think as this inflation worry really kicks in over the next couple of weeks, maybe the next few months. And it's going to force the Fed's hand to move a lot faster. Remember, the Federal Reserve doesn't set policy. The market sets policy. So as long as the interest rates, the 10-year continues to waffle around 160, they can say whatever they want. If 10-year yields shoot up to 190 or 2%, they're going to be forced to react. If they shoot down to 1% or 90 basis points, they're going to be forced to react. So right now they can pretend that they're in charge of policy, but ultimately we're just waiting for the market to make a decision. And they'll do just like they did in 2013 with the taper tantrum, in 2018 when they were trying to put it on the balance sheet on automatic pilot. The market threw a fit and they immediately reversed their policy. So that's what I think is the risk here, is that the market's going to throw a fit and that they're going to have to reverse their policy.
Okay, so Jim, hold right there. Michelle, on the other side of this, I want to come back to you on that issue because you have a way to avoid interest rate risk. But I've got to get to Jared Blickery for his final thought. Jared?
Yeah, seeing some more weakness in the NASDAQ. This is a level 13,800 I've been watching for some time. I'll draw it on the Wi-Fi interactive. Here's the most recent high. Here's the most recent low. And we sold off right from where we were looking at it, or at least I was. And I'll tell you what, going into tomorrow, it's a big day, but if we see any strength, it's quite possible that these levels are now going to be sold into. So it's really next week that's going to be telling. If the market rallies tomorrow, I'm a little bit skeptical of it, especially given the retail rise in options volume and also the very low put to call ratio sinking to historic lows once again.
All right, Jared, let's get back to the panel. And Michelle, you've talked to your clients about avoiding interest rate risk. How might I do that, but also achieve a higher return in different kinds of assets to invest?
Well, looking to the bond side of the portfolio, there are senior floating rate debt interval funds that are paying a nice 5 to 6%. Sion Ares Credit has one that you can get out and in on every quarter. I think that would be a nice way to increase returns. And then on the equity side, we also have managers that are looking at dividends from blue chip stocks with calls, that options with overlays that are making as much to 9-11%. One example of that would be JP Morgan's equity premium income. I believe they have that in an ETF form.
Jim, let's talk crypto because we saw crypto get a bit of a bump today, although still below 39,000. I was going through your notes. You're a big bull on crypto right now. You say that it's going to lead to a significant disruption to the financial system. Elaborate on exactly what you mean and why you're so bullish on crypto now.
Well, there's two things going on in crypto at once. One is an out-of-control casino, which sucks up all the oxygen, and everybody wants to know where Dogecoin is this hour and that hour. But beyond that, if you look at what's called the decentralized financial space, there is a reconstruction of the financial system in a new and different and decentralized permissionless way that if you start to dig into it and understand it, you can start to see that the very nature of a bank and of a brokerage firm and of an insurance company is going to radically change in the next 5 to 10 years as these new protocols come online and the ways that we understand a bank works and a brokerage firm works and an insurance company works and a finance company works is going to change in ways that we're only now beginning to understand. We've seen lots of industries go through disruption. Newspapers, retailing has gone through disruptions. Taxi cabs have gone through disruptions. Hotels have gone through disruptions. And they've come out the other side very different business models than when they went in. It's now the turn of the financial services industry. And it's at the very beginning of it. And I think crypto is going to lead that charge.
Okay, again, we got to pause. We have another earnings report. This one from Slack. We use Slack here. Lots of people do. And shares are trading down slightly after hours. What did they report, Dan?
Have a beat on revenue as well as earnings per share, adjusted earnings per share. Revenue was $273 million versus $265 million expected. Earnings per share, we have 8 cents versus an expected loss of 1 cent per share. And the big deal we want to talk about is the number of users who signed up. Now, we're looking at 36% up year over year on that revenue. New paid customers, 13 Now, one of the big deals that we've been looking at is why they haven't seen the revenue increase or the user increase over the years that something like Zoom has. I don't think these numbers are going to have people very satisfied. 36% year over year versus 100 and something percent year over year that we saw out of Zoom. They haven't done that throughout the entire pandemic. And obviously, this is likely their last quarter as an independent company as Salesforce comes in to scoop them up with that acquisition, which is expected to close later in the second quarter for Salesforce.
All right, Dan, thanks so much. We also got Lululemon out with its report. Emily McCormick has that for us. Emily?
That's right, Sean. And we are seeing shares of Lululemon moving to the upside, up now about 2.5% in late trading after delivering first quarter results that topped expectations on the top and bottom line. And we saw net revenue coming in at $1.2 billion, better than the $1.12 billion expected. And earnings per share were $1.16 versus the 91 cents that were anticipated. Now, the company also raised its full year net revenue guidance. It now sees between $5.83 billion to $5.91 billion, and previously it saw between $5.55 billion to $5.65 billion. Should also note that second quarter net revenue guidance from the company also came in better than expected at $1.33 billion on the high end of that guidance range, whereas the estimate was for $1.2 billion among Wall Street analysts. Now, just pulling a quote here from the press release from Lululemon this afternoon, CEO Calvin McDonald saying, quote, "Our first quarter results reflected strength across all drivers of growth, fueled by the continued expansion in our e-commerce business and a rebound in brick and mortar stores." Now, again, we are seeing shares of Lululemon moving to the upside in late trading, although we should note that they are still down about 8% for the year to date. It's been one of the retailers that hasn't necessarily benefited from that rotation to the reopening trade. One of the reasons for that is that we, of course, saw Lulu becoming quite popular as people were staying at home and looking for comfortable athleisure during the pandemic. But at least for now, we are seeing Lulu pairing some of those losses in the after-hours session. Shauna and Adam.
Emily, thank you. Let's get back to the panel. Michelle, wanted to follow up on something. When you were talking about dividends, when I think of, a conservative investor looking at a dividend play, I think of my own parent company, Verizon. Stock has gone sideways for a couple of years, but the dividend's pretty strong. I think the yield is over 4%. Could you get trapped in going into a dividend play, or is now the time to consider that to protect what you've already earned over the past year or two?
I think it's a good way to protect what you have going forward. I mean, we're going to have to rely more on strong cash flow, and that includes the dividends that those companies are generating. So I would be looking closer at some of those names, even if they've had some upside, in the value and the cyclical camp.